Thank you for joining us. They say that there's only two certainties in life, death and taxes. And if you're a contractor, maybe there's three: death, taxes, and maybe OSHA showing up right after you forgot your hard hat, those kind of things. But today we're going to talk about how to at least get ahead of one of those things, and that's taxes. We have a brand new tax bill that came out, signed last Friday as we're recording this. Depending on which news channel you watch, the one big beautiful bill is either the second coming of Reaganomics or the opening scene of Mad Max, where we may be trading our wheelbarrows for gasoline. I don't know. Again, the left says it's a handout to corporations. The right says it's a return to freedom. And the construction world says, does it mean I can actually write off my dozer now and afford to keep my foreman? This is not about a political discussion. Today is about what I see as a CPA that's been working with contractors for about 35 years now, running our Contractor Success Forum podcast on various channels. Sometimes we say things that get us blocked or whatever, but today is about getting out there. This is my opinion, and other people may have others, and this is not about politics today. It's more about what I see coming, as well as my interpretation of the tax law. And as we're getting into this, one thing I would say is that there's a lot of interpretation when a new law comes out. Sometimes the IRS will interpret things different ways. So before we get too far in this, as I was saying, the OBBBA, ABBA, whatever you want to call it, the One Big Beautiful Bill Act, this was sort of like the pseudonym for it, something that the president called it, and it's basically the name is stuck. Officially, it's the HR 1 of the 119th Congress. But as I was saying before, when we have a new law come out, a lot of it sometimes is subject to interpretation, sometimes subject to getting in and actually applying the law, having case law, those kind of things. And some of these things we just don't know yet. There's a lot of things that are very clear and a lot of things that made what happened with the bill, and there was some uncertainty. So the reason I wanted to do this whole thing was because there's a lot of impact to the construction industry, and there's some things you need to know. With that said, I'm going to advise you not to take what I talk about here just and go off and do it. You need to go back and talk to your own CPA, your own qualified tax advisor, and make independent determinations, because some of these things can and will, you may know one part of this, but there's another part that could be a gotcha. So with that said, I'm just going to move on into this. And as I said, the law did a lot of things here, not only taxes, and we're going to talk about some other unintended consequences as we go through this, but what it did, and we'll talk about some permanent changes as well as some temporary changes. But this made a lot of the changes from the 2017 Tax Cuts and Jobs Act permanent that we're going to talk about as we get into it. But it could have been a big cliff for contractors. It wasn't really expressed well, but that 20% off the top, that's one of the biggest one that was going to expire and would have been a big hit to contractors. So some of those things have been now made permanent. We'll talk about it. But as I said, it was signed last Friday on July 4th, and it is a budget reconciliation act. Nobody got what they wanted, depending on what side you're on. But what really matters here is that the law has changed. And whatever your opinions are, you need to make some adjustments in your own life and your own situation. There are some things you need to think about for this coming year. So with that said, why does it matter to construction? Well, a lot of these things do have to do with not only, I mean, a lot of them are not really that corporate related as far as C corporations only. What most of these things do, whether you're a contractor that's a sole proprietor, partnership, or an LLC, which taxed as either one of those or taxed as an S corporation, all of this stuff is going to pass through to your personal income taxes. So there's things that apply that are going to be on the business side and some that apply on your personal side. But a lot of this may stimulate the economy. There's some spending that is going to affect construction. We are going to see some direct impacts from this. And as I said, the strategic planning, some of this stuff you don't need to wait until 2026 when you start doing your 2025 return to think about this stuff, as well as we're going to get into some of the stuff on federal contracting. If any of you follow the Contractor Success Forum podcast that we do, just a few weeks ago, my podcast partner, Stephen Brown with McDaniel Whitley Bonding and Insurance, he went to the FedCon. AGC has an annual convention in Washington, D.C. that talks about federal contracting and some of this stuff. And even then, there's a lot of federal contracting opportunities out there. This new law adds a lot of things to it, as well as some things are permanent, some things are temporary, but it does change the game for planning for a construction company. So this is the time I want you to go back to your own CPA and do some strategic planning. And that's part of the goals for today. Why does it matter? The 2017 Tax Cuts and Jobs Act came in, and it was actually, they were supposed to expire in 2020. They did expire in 24. So this coming 25 year would have been a cliff. And so with some of these things being made permanent, we can now do some long-term planning that we never had before. And a lot of things in the new law were designed to encourage business investment, workforce growth, those kind of things. As I said, we're going to get into $130 billion in infrastructure building. And if you're not a federal contractor right now, there's a lot of opportunity out there. And if you think you're too small, well, a lot of these big companies are looking for people to partner with. And there's some joint ventures, and we'll talk about some of that stuff. But it does open up a lot of strategic opportunities, as well as some things with your workers and that kind of stuff as we get into it. So I'm going to just jump into some of these permanent changes, because these are some of the things that really did make planning a lot easier now that we know things are going to be either permanent and they have to actually write the law again to change it. Whereas the ones from the Tax Cuts and Jobs Act from 2017 were, a lot of them were temporary and they did expire. So the brackets, the tax brackets were brought down. The top bracket was 39.6 before the 2017 Act. It brought it down to the 37% and raised the thresholds. Well, that part is all locked in now. So they've kept it at the lower rates permanently. And so, again, this is some example rates. And depending on whether you're married, filing joint, or single, or head of household, some of this stuff, these were made permanent. These income ranges are being indexed for inflation. So they're going to go up every single year. So at least we have some certainty and we know what to expect on some of these things. There were automatic tax increases that were supposed to be scheduled for 2026 that's now taken out of that. But, you know, it allows us to do a lot better cash flow forecasting, allows us to, and as well as planning for profit and planning for that tax bucket. I know if any of you are familiar, I wrote Profit First for Commercial Construction. It came out recently in the last couple of months. And planning for taxes has always been one of the key things that contractors have always wanted to. I've never met a contractor yet that loves paying taxes, but the game is to plan for it and being prepared for it. And knowing the law is one of the best ways you can basically take advantage of some of the benefits of it. Now, one of the things that the 2017 Tax Cuts and Jobs Act did was significantly raise the higher standard deduction. The personal exemption part, they kind of phased that down and significantly raised the standard deduction. And with that, it actually made filing for a lot of people a lot simpler to do. They weren't trying to dig up all these receipts and find all these itemized deductions, because a lot of people actually came out a lot better with the standard deduction. Depending on where you are and where you're listening is from, there's certain states where we had state and local income taxes and they capped that at $10,000. Well, you know, that hurts some people in these higher income states, and we'll get into some of that. But they just, spoiler alert, we did actually bump that considerably. But the point here is the standard deduction, this part was locked in and it is going to be indexed for inflation. But, you know, whereas the before the Tax Cuts and Jobs Act, the married filing joint standard deduction was like $12,700 before 2017. The single was 6,350, and then we bumped it to 24,000 for married. You can see now it's up to 31,500. So again, one of the things it did was made it a lot simpler, and now we can count on some of these deductions, as well as they got some new ones in here that you're going to want to hear about here. So as I was just saying, these personal exemptions, the previous tax act basically set them at zero and then allowed you to put them all in to your standard deduction. You lost the exemption. So if you had a lot of dependents, then depending on your personal situation, it may or may not have come out better, but most people did. The majority of the Americans did. So this, under the new law, this actually sort of made some of this permanent, where the personal exemption went to zero, but they did also do some stuff, the credits I'll get into in a minute. They are focusing on how to make it simpler to file, and some of the stuff they made permanent, they bump some of these benefits here. So it does create some planning opportunities for timing deductions and the exemptions, those kind of things. So as far as removing the exemptions for your dependents, they did back in 2017 that they had the child tax credit. And before 2017, it was $1,000 per child under 17. And they also said that $1,000, you could not get that refunded. You could use it against regular tax, but it was not allowed to be refunded. The 2017 Act bumped that up to $2,000 a credit that you could use against taxes, and then made where you could get up to $1,400 of it refunded. What the new bill for the OBBA, it sounds like I got a really bad stutter, I don't know, but they bumped that to $2,200 per child, as well as they took that $1,400 that can be refundable, and they're going to start indexing that for inflation. So that will also be kicked up into where you can get more credit and more refund, even if you don't have tax to use against it. So there are some phase outs depending on if you're married filing joint. I think it's $400,000 or $200,000 for single, but the phase out is, I mean, before, what you could get now would be like $6,600 in credit. Before the Tax Cuts and Jobs Act, that would be for like $1,800 worth of credit. So there's a big difference in what the credit would be if the previous law had still been in place. And remember, credits are just like taxes paid. So this is, again, some of it where you can get some money back. Another one that hits contractors more often than, or at least it did before 2017, was the alternative minimum tax. And for the middle income taxpayers, as well as a lot of construction business owners, they got hit with things like, if you had like long-term contracts and you had percent complete versus a cash basis. Well, those were adjustments that would kick contractors up into alternative minimum tax. So even if your cash basis income was down here, the alternative minimum could say, you're going to have to pay this minimum tax. Well, 2017 Tax Act fixed a lot of that for the, at least the middle income people, but some of the unintended consequences, like the SALT deductions, those kind of things, that kind of stuff got thrown out. And now the newest law that made having this alternative minimum tax kick in on middle income taxpayers a lot less likely. So the threshold between where it hits and it has gotten larger, and you're far less likely to ever get hit with that extra tax. Most of you may not even think about that one, but it did hit a lot of my contractors more than you would think. So let's get into some of the other things like the itemized deductions. There's the mortgage interest, as we had before. There was a cap like $750,000. Now we can add some things like the mortgage insurance and some of those things in there. After the 2017 Act, the miscellaneous deductions, a lot of those were permanently eliminated, but things like educators, and they had some unreimbursed business expenses, those kind of things. Some people got hurt by that too, but there was also, they kept in the law where we had casualty losses with theft or whatever, or mainly after the 2017 Act, you could still claim like the federally declared disaster areas. And after the current law, they've also included state declared disaster areas. And I know just coming out of the last week, unfortunately, we had the situation with the flooding in Texas and New Mexico, and it's a horrible situation. And I probably believe that some of that's going to be federally declared, but even if it's a state declared disaster, it will now count under the new law. Also, the only thing I really wanted to mention that it's known as the PEASE after a congressman in Ohio back in 1990, but they would limit how much you could deduct for itemized deduction. And I'm not going to get into how that's phased out and all that stuff, but the thing you need to know here is that repeal has been made permanent. So no matter how much you make, you can still get itemized deduction as long as they qualify. So that does help some earners. Now, again, talking about the SALT deduction, that's state and local income taxes. And that was a big thing after the 2017 Tax Act. They bumped up the standard deduction, but they capped the $10,000 in state and local taxes that could be capped. The new law, they have temporarily bumped that cap to $40,000. So a lot of these people in states like California, New York, Illinois that had really high state income taxes were now going to be able to bump that up to $40,000 if you've got that much in state taxes and still claim it. So that's going to help a lot of people as well. The $40,000 cap is going to, again, be in place for the next 4 years. And it is indexed for inflation. So it will go up a little bit every year. And so if you're experiencing some of the unintended consequences, we'll get into that. But the SALT deduction spurred all these things for contractors where each of the states started trying to put their own situation in there where they can do pass-through entities. So they would tax the company, even if it's like an S corporation or partnership, they could tax it at the company level and therefore get a lot of the same benefit from it. It was clunky and it still is clunky. And a lot of times, especially in some of the smaller states, it really took a lot to where it would really make any kind of difference. So there was a lot of work to be able to do this. And a lot of these people have put things in place. And now some of these state laws that were put in place to be able to do that, now they're sort of probably becoming null and void, at least for the next 4 years, because it probably is simpler and less hassle and less cost to actually do all the tax returns to do that. These PT, that pass through entity tax workaround, that's what I'm talking about there. Now, a lot of that stuff probably will go away for some contractors. This is the big one here, the qualified business income deduction. This is the one everybody in my profession was really worried about, that was actually supposed to expire. And a lot of people have gotten used to this for the last 8 years. You may not even realize you get this. If you're a pass through, if you're a sole proprietorship, partnership, LLC that's passed through like that, S corporation, you got the 20% off the top. So you make $100,000 worth of income, and as long as you qualified, you would only pay taxes on 80. That was a huge benefit to contractors. And it wasn't just contractors, it's business in general, as long as you weren't certain specified, I won't get into that, but specified service, trade, or business, the doctors, lawyers, engineers, architects, and they actually have made all this stuff permanent, as well as loosened some of those restrictions on your architects and engineers. And I don't know about the lawyers, and depending on who's listening to this, whatever your opinion. But anyway, this was huge. And when I was doing taxes for 2024 for my contractors, we're always doing the tax projection for the next year, as well as we do it again in the fall. And we were hoping this was going to be the case, but I was warning my contractors, we've got to be prepared just in case. It's not only a 20% loss of deduction, you would bump up your tax not only by 20%, but if it kicked you into another bracket, it would be potentially more than a 20% increase in your taxes. So this was huge. And this was something that when they put it into place originally in 2017, we spent a lot of time calculating this and figuring all the nuances. And this is especially one of the areas that took a lot of interpretation. We've pretty much got them down now, but now that it's in place, and it is crucial for about 95% of contractors getting this deduction as far as keeping your taxes down. And so there are some ways to optimize your salary versus distribution so that you can maximize this 20% deduction. With it being permanent, may raise some questions. And I don't know who's on this call, if you're a sole proprietorship, or this may take you going back and revisiting, if you've never thought about electing S corporation, or you just set up an LLC because your friend said that's what they did, and you never really learned why, but you've been paying the self-employment tax. This may be another reason you should probably go back and see what you can do about optimizing your taxes. Anyway, let me talk about some of these other things. This may be another one you may not even be aware of, but the 2017 Tax Cuts and Jobs Act had a limitation on the amount of business interest you could deduct. And for my contractors, the heavy equipment guys, the highway guys, the guys with big bulldozers and excavators, thousands, hundreds of thousands of dollars in equipment, that you could easily run up some interest charges. As well as post-COVID, we had EIDL loans, we had some of these other things where we had contractors run up some significant interest charges. And you don't want to lose that deduction. Well, it was limited to 30% of your earnings before income taxes, depreciation, and amortization. So now what they've done is they've increased that cap. So one of the things, they've still got it at 30%, but they calculated it differently. So before, they didn't take off depreciation and amortization. So, they could take that off now, and that way we really can bump up the amount of interest you could claim. So say you were a $500,000 contractor, or like of EBITDA, whatever, that, and you had, I'm just making up numbers, but $200,000 of interest. Before, you could probably, that would be capped at $90,000. Now you could get like the full, say, $150,000 worth of deduction off the top. So anyway, again, this may not be something that directly affects you. A lot of contractors may not even realize that these kind of things could actually be affecting your tax return. You don't even really see that, whether you're familiar with all that stuff. Next point on this, the R&D deduction, the research and development. And you may be saying, I don't run around with a lab coat or whatever, but there was some credits in there for research and development. It may not be what you think. You may not be running a lab with test tubes and beakers, but research and development can be like investing in BIM, building information modeling, the upgrades to your systems, the workflows, custom job site tools, developing some of these technologies. Well, before, it would have to be written off over 5 years. And now, there's like immediate expensing of that. This is one of the few things they actually did go back and make retroactive. So if you've spent some money in the last 2022 and 23, 24 for research and development, have been amortizing this, it may be, if it's enough money, it may be worth going back and seeing if you can get some money back on some of these things. If you already expensed some of the stuff up front, you can't do it. I've had some contractors that have invested in building out software for the construction industry, and they've gotten some credits like that. So again, if you're doing some of this stuff and got limited, there may be some opportunity here. That's all I'm trying to say here. I'm just trying to make you aware of that. So this is some of the big stuff here. The Section 179 expense deduction, you may be familiar with that. That's where we can write off our equipment, tools, vehicles, like vehicles like over 6,000 pounds of trucks. And I won't get in all the nuances of it, but before the 2017 Tax Cuts and Jobs Act, it was severely limited. And back then, they wanted to spur the investment in this. So they bumped it all the way to, I'm trying to remember what it was, but as of 2023, it jumped all the way up. They indexing it for inflation, jumped to 1.1, almost 1.2 million, where we could expense that much. But it started phasing out. If you bought more than like $2.9 million of equipment, you couldn't start getting some of this where we could write it off immediately. And again, it's not just the guys with the excavators and big dump trucks or whatever it is, but pickup trucks and all that stuff. If you got a fleet, a lot of times this is what I use first. And we're going to get into the bonus depreciation if you're familiar with that. Some of that was getting phased out, but this was a huge bump. And again, designed to hopefully stimulate the economy. Again, depending on where you see it, construction goes in phases and cycles, and economic cycles in construction can be quite devastating. We saw the 2008, 2009, 10, depending on your commercial, residential, we saw a huge drop, and it took a while to come back. And then we start spiking up again. And then we hit COVID, and depending on what side of construction you were on, you might have gotten hit with some of that stuff again. But I mean, I see a lot of this stimulating construction. And I'm not telling you go out and buy a bunch of equipment to just to buy it. But if you're in a growth mode and you're going to need this equipment, and it's a good time to capitalize on some of these opportunities. So again, I want to make sure I get through all this and get to your questions. So I'm going to move on a little bit. The bonus depreciation. So 2017, they put in place the 168K bonus depreciation. And what it did was had another way of getting 100% deduction right up front on your equipment, not using the 179. And so that was where you could do some full expensing of new and used equipment. And I need to be careful about that because I need you to understand there's a difference here, but you can use this on used equipment, but you have to be like the first user of this. The other 179, you could buy a used truck and write that off immediately. And again, with this bonus depreciation, a lot of states, like I'm in Georgia, a lot of states did not recognize this bonus depreciation. So we had this difference between the federal and state, but it does cover all these things like cranes and trucks and all this stuff, not real estate. There's special classes for that, and I won't get into. But again, if it qualifies what was happening, the previous law was phasing down. So as of, I believe it was 22 was the last year, it was 100%. 23, it dropped by 20%. So it dropped to 80%. 24 was 60%. So you could get like 60%. And it was supposed to drop 20% per year so that it was phased out completely. That's been put back in. And again, this is one of those things that appears to be permanent. So again, with that, if you got some equipment, if you're ramping up, again, there's a couple of different ways we can go ahead and get the expensing now that we can count on, especially for a while. Depending on where you are on this, I'm trying to have a wide variety of how this affects the construction industry. We had some people that lost considerable amounts of money post-COVID. Some people had boom time in COVID. Some people came out of COVID. They were dependent on these PPP loans. They had EIDL loans, the disaster loans. We also have some things to talk about with the ERC, but that we'll get to that. But we had some big losses, and they were limited in the past. And so they put some things in there where we can claim some of these limits. If you got a joint filer, as of now, you can deduct up to $626,000. It wasn't going to be limited by your other income, W-2 income. And again, I know I'm hitting top level here, but if you got some losses, you can go ahead and claim them and not have to wait and carry them back. If you actually have something over and above that, you can actually carry that forward up to 20 years. And so a lot of this stuff is now permanent, and it's a good thing. I had a concrete contractor recently hit a really bad year, and he's going to have a rebound year. And some of these things are going to come into play. So again, it depends on your situation, but just want to make all the contractors aware of that. This is another one that you may say this doesn't apply to you, but let me give you some context. Okay. So the estate tax, or as I was just referring to my wife, like, what's the death tax? This is what we're talking about, the death tax. Well, it had started being adjusted, but for the longest time, if you had over $1 million estate, you got hit with this death tax. And $1 million a day is not a lot. And so for a contractor, a lot of my contractors can do well and eventually amass a lot of wealth. But, what ended up happening is, like a lot of farmers, somebody would die and they would have a very taxable estate and they would have to sell off their farmland. Well, same like with contractors, they'd have to sell off their equipment and all this stuff just to pay the taxes on it. Well, the Tax Cuts and Jobs Act 2017 bumped that to 5.5 million. And then we've been indexing it for inflation, and it was temporarily raised to 13 million. It was supposed to drop back. Now it is raised to $15 million per person starting in 26, as well as if you got a married filing joint, you could go up to 30 million. So effectively, for most people, we're not the Jeff Bezos and whoever. I don't want to, we don't have millions of dollars. I mean, well, maybe you do. I hope you do if you're listening to this, but at least you got a haircut on what you're going to have to pay on estate taxes. And again, that plays into the gift tax, because if you're gifting amounts, you can always use that lifetime exclusion. Again, not trying to get in the weeds here, making sure we get through all this. So there are some temporary deductions that you should know, and some of these do have to do with your workers, and you may want to pay attention, because depending on what's coming for you and what you see, if you're scaling up, some of this could be applicable. This is one that I don't know that it necessarily plays into the construction market, but they did pass that no tax on tips, and there's some limitations on that, up to $25,000 above the line deduction for tips for single, or up to 50 for married filing joint. And post COVID, it's not just tips for somebody at a restaurant. It's your Uber drivers and your Instacarts and your DoorDash. All these people are getting tipped. Josh Menzel, that's on my team, he's my construction systems guy. He used to work restaurants and wait tables and stuff like that. And he's like, I always claim my tips, but 99% of the people that are doing this do not claim all their tips. Well, again, for these people, maybe they're claiming them, maybe they're not. But if they're in this particular class where they're getting this, they're not going to have to pay taxes on that. So that is going to be a significant boost to some of those people there. But one of the big things that you may want to know about is the no tax on overtime. Contractors don't like to pay overtime. Obviously, it's going to cost you time and a half. But, some contractors do regularly pay overtime. And so for these workers that are getting this overtime, they're not going to have to pay taxes on this. So in a way, they're getting bumped. And this is one of the things that I don't know how they're going to treat this. They may actually be changing the payroll tables to where you don't have to withhold on that. So I've actually, and I guess there's a point in here in my slides here where we talk about maybe using this as a recruiting tool. If you regularly pay overtime and you're scaling up and you're struggling to find people in this business, I think this is something I'm going to talk about in a minute. There are some limitations on that, but it could have some impact on recruiting and retention. So just wanted to mention that, and maybe something you want to mention to your workers as well. This is another one a lot of contractors have asked me about: car loans, interest deduction. And before, well, it's been a long time since we could really deduct car loans. And I mean, that's many years ago. But they've now put in there where you may have a loan interest deduction for vehicles that were assembled in the US. It doesn't necessarily have to, I mean, it could be a Japanese car, but as long as it was assembled in the United States, we can deduct up to $10,000 interest deduction per vehicle. And there are some phase outs that I've got here on screen. But, a lot of contractors, they ask me about that. And it's one thing if you got the vehicle in your company name, you can deduct that interest. But if it's a personal vehicle, or if it's your daily driver, or you got one that you drive partial business and partial for personal, and maybe you just had in your personal name, now we can write off some of this interest as long as it's U.S. manufactured, assembled here vehicle. And again, there's some phase outs, but I've gotten a lot of questions about that already. Now, this is the other one, which I came out of this past weekend thinking, and I actually talked to my team about it on Monday, because there was a lot of publicity about they were not going to tax Social Security. And there was a lot of desire to do that. And I was actually somewhat shocked, because I told them I thought it had passed, but they did do something to help the seniors in lieu of doing this. And what they did was did a temporary provision for seniors where they're going to take $6,000 off per person as long as you're over age 65, an additional deduction for that. So again, there's caps if you're 200,000 or 400,000. If you're single versus married, I don't know if this applies to you, but I've got a lot of contractors that are still working well into that. Charitable giving after the Tax Cuts and Jobs Act 2017, we eliminated a lot of these charitable deductions where we could itemize. I mean, you had to be able to itemize before they started counting, but there was like a minimum because $300 for single or $600 you could claim off the top. And so now they have not only put that in there, but they bumped that to where you can deduct up to, if you can't itemize, you can still deduct up to $1,000 if you're single or $2,000 if you're married filing joint. So there is a floor and there's a start capping out at 200,000 and it's like 0.5%. So if you had 200,000 of income, your first say $1,000 of that would be eliminated. But anyway, let me continue on with some of the things that are going to affect the industry. If you had student loans and repayment and some of these discharges, a lot of that had to do with people going to college. And some of the changes here that I'm going to get into, these came into play for the 529 plans or the Pell Grants. Pell Grants were for college kids. If you had a kid you wanted to swing a hammer instead of being a bean counter like me going to school for accounting, you couldn't get the government to pay for it or at least help pay for it. Under the new law, these 529s can actually pay for trade school, as well as Pell Grants can go to cover skilled trade programs like this. So some of this is huge. The desire was to spur some of construction and getting people into the trade. We all have seen it. There's been some shortages and more funding for apprenticeship programs were put in there. Maybe this is a time to engage some of these trade schools for talent. And if you're scaling up, I've had some general contractors that have done some things to make sure that we've got some project managers coming through school and they help them through school. But anyway, I don't think we could have too many people coming into the industry. We have too many people retiring. Some of the stuff that it did where if you had somebody that's disabled, the 529 plans could be rolled into that. And it could also be used for trade education, some of that. But anyway, let me get into the infrastructure, the 150 billion. There's going to be a lot of federal contracting opportunities. And again, not getting into the political sides of this, but they put in there $46.5 billion for border wall construction. That's some of the security infrastructure, 45 billion to build some detention facilities. So some of these things are more the civil security, the earthwork type contractors, but there's opportunity out there. And again, this is where I'm mentioning that maybe you should think about doing federal work or at least explore it. There was also some stuff that was put in there for defense and aviation. So there's $150 billion for like base upgrades. And a lot of the stuff that's in that had to do with technology as well, but it also could be barracks or it could be broadband. There was still some things for people building buildings that can go in there, training centers, those kind of things. Same thing with aviation. They put $12.5 billion in air traffic control towers. So again, some of those are more technical, but there's opportunities out there at some of these airports and those kind of things. And then this is one of the things that this is coming through the federal, but basically they want to make sure that like rural counties or places that don't have a lot of traffic. I mean, they were not being well served by hospitals and stuff like that. They put in there $10 billion to help fund some of these clinic constructions in the middle of your state. I'm not exactly sure how they're going to fund. I think some of this is going to be like more grants that may be state funded, or I'm not sure who it's going to go through, but it may not actually be federal contracting. I don't know, but they've got another 20 billion for the year 2 and 3 and another 20 for years 4 and 5. So a total of 50 billion to be, depending on where you are, could be in your backyard. I don't know, just something to think about. But again, there is a big demand in some of these underserved areas. The building, I mean, domestic manufacturing, they're trying to bring some of that stuff here. But what we've already seen, even after the election, and there's been a lot of uptick and this goes back to the tariffs and all of that, where people were getting around the tariffs and they start building here. There's been a lot of foreign investments and already a lot of investment in building manufacturing facilities here. And been several $billion spent every month for several months now. They've got to have places to do this. So there's private work as well as they are getting into these traditional energy. Again, it's the change of philosophy, whatever, the oil and gas, but some of the pipeline stuff is coming back, oil pipelines, that kind of stuff. And again, this is not a political discussion, but trying to give you a high level overview of this. If you are looking to scale up and we're trying to find people and finding a team, I mean, overtime is a recruiting tool, but you may want to start thinking more about your strategy. You do need to strategize about your taxes, but you also may need to think about securing your labor force if there's going to be labor shortages. You may want to think about whether you need to invest in additional compensation, training programs. Those things can go a long way to securing your labor force. There was something I really did want to put in here, and this is sort of a peripheral thing, but they did put something in this law that, like, if you're on a federal contract, there's prohibited foreign entity. There's a clause that against it's the Chinese trade and all that stuff. They put something like if there, you can't have Chinese steel, solar panel, or wiring on these federal projects. And this is actually something that is very enforceable. And the government has said you will get banned if you get caught using Chinese materials on federal jobs. I understand some of that, but I guess one of the ideas is maybe you should vet your suppliers, make sure you know where your stuff's coming from and documenting that stuff. Because if you get into federal contracting and you get kicked off a job and then permanently banned, you don't want that. So just a quick warning. Another thing that need to really point out, and I wish I had more time with this, but the employee retention credit, a lot of that first of all, that program is officially closed, and a lot of those claims were out there, but there was a lot of people out there claiming that you could get it. I don't care what you did, you could get it. If you had people, there was these mills out there selling them and making lots of money, and a lot of contractors got some, and some of them were very legitimate, but a lot of them were not legitimate. And so there is something in the new law that made these things very auditable and extended to 6 years the amount of time to audit these things. So even though you may have gotten the money, you may need to make sure you got all that documentation in place. And again, if they found that you've abused, I believe it's like a 20% on top of repaying the stuff plus penalties, as well as these ERC mills, huge penalties. The minimum penalty is $200,000 for the companies that did these things. What I do want you to know is that there's some things that are changing. There's some opportunity for federal contracts. If you're not familiar with doing those things, a lot of larger companies are out there that need to partner with smaller companies. Sometimes there's a requirement that they have lower end, smaller companies on these jobs. So again, don't dismiss it if you haven't really looked into it. Go into sam.gov. This is the time to go see your CPA, and they need to do some planning for you. The updated tax projections, if you've already made adjustments for that, maybe you can drop it down. Succession planning, again, the estate planning, that kind of stuff. There are some things that are temporary. But with that said, I guess some of the takeaways I'll sort of skim through, but don't sit on this. But the goal is do not sit on this. Go learn about these things and how they can affect you. And don't wait until 2026 to figure this stuff out. We appreciate you. If you've hung with me this long, I really do appreciate it. If you enjoy this kind of stuff, we have the Contractor Success Forum we've had going for, I'm working on 4.5 years now. We put out content like this, but we want to do something special here with this Tax Act because I saw a lot of things. But visit us on YouTube, the Contractor Success Network, Carpenter CPAs YouTube channel. There's a QR code right there. If you want the slides, you can use that QR code and get that, and we'll get them emailed to you. Again, appreciate you being here and your attention, and I hope you found this helpful. I appreciate your time. Join us. We do this every single week with the Contractor Success Forum on YouTube or the podcast. Also, my book is out, Profit First for Commercial Construction is out. Go see that on Amazon. I think you'd get a lot out of it with cash flow or your profitability. So again, thank you. Have a good night, and we'll talk to you soon.